everyone. Welcome to the P1 and Firenze webinar on Lombard learning for IHT planning. Good to see a fair few many familiar faces on the list of attendees. So I think a lot of people have joined for previous Lombard lending sessions, but it's good to have a kind of focused deep dive into it from an IHT angle. You've got myself and James today. So James, I think everyone knows you. But if you want to just give a little bit of an intro and background and context for today as well.
Yeah, absolutely. Yeah, thanks, David. Yeah, so I'm James Priday, CEO of P1. Part of the P1 proposition is our platform, which is a core focus for us, and we've been working with David and the Firenze team probably for about 18 months now. So yeah, hopefully that gives the background you need.
Great, thanks, James. Today, as I say, it's all about the kind of Lombard and the context in IHT. Cognizant though that there are a fair few people that have not come across Lombard lending before, and it is new to some of the audience. So what we are going to do today, we're going to do a little bit of scene setting from James on the kind of the background of the changes, which obviously everyone's will be aware of. So we'll be very cantered through, and just some of the things we're seeing on kind of how people are responding. But then we're going to do a little bit of kind of background introduction to Lombard lending, how it works, set the base for kind of an understanding of Lombard lending, and then just talk through a few examples and case studies of where we've seen Lombard lending used in the context of IHT, why it's increasingly a relevant part of the toolkit for advisors, and then kind of open up to kind of questions around how people see it utilized, things people want to dig into further, and talk on any topics in any direction that people want to go to and create this an open forum. But we'll probably talk for half an hour or so and then leave plenty of time for people to delve in.
Perfect.
Great. So if I just click through. Great.
So obviously there's some big changes that are happening that I think everybody on the call will be very aware of, and means that the financial planning landscape is going to start to change in terms of, bread and butter financial planning for a long period of time, included, pensions, great place to leave assets, that if you don't need to touch them, very tax efficient from a intergenerational planning point of view. And of course, changes made by the government are starting to come through, and we need to start looking at different avenues to be able to do effective planning for clients. So what does it mean? Obviously the changes that are coming, unused pension pots being brought into the client's estate for IHT purposes. I think everybody on this call should be aware of that, that's happening. If you're not, probably want to take a look at it, because it's a pretty major change for your business probably. And therefore client estates now more exposed to IHT. Therefore IHT has got to go up the agenda from a financial planning perspective. Moving on to the next slide. There's potential increased IHT bills that need to be considered, and when there's increased IHT bills potentially coming, that means they're going up the priority agenda with clients, and actually planning needs to start taking place probably further in advance than it would have otherwise done. Obviously people aren't saving enough for retirement is another issue, and this is potentially being exacerbated by the IHT changes, where people are potentially going to save less into their pension because they're worried about it being tied up and exposed to IHT, and just generally this lack of liquidity in retirement due to rapid drawdown out of pension schemes, and obviously people not saving enough into those pension schemes. So what are the knock-on effects of those things? People are crystallizing their gains earlier on as they're going into retirement. That's creating tax issues, throughout their lifetime. And people aren't willing to save as much as we've just touched upon for their long-term retirement planning. They're losing out on valuable market exposure because they're not saving into their pensions. They're not leaving it into an investment portfolio for the long term, both as they're accumulating, but also beyond retirement and over the long term. And it's massively disrupting these IHT reforms and reforms to pensions coming into the estate. It's completely changing those long-term plans that are potentially being put in place for years and years and years with your clients. Therefore, the situation's quite bad and it's about to be made worse. So solutions are required to deal with this. So how are advisors responding? They're looking at pensions as maybe the first point of call to draw assets from, whereas previously, before we knew these reforms were coming, they were thinking, advisors would be telling their clients that maybe it's the last pot that you should touch, because it is efficient from an IHT perspective. They're pushing earlier gifting to children and any beneficiaries of the estate. That's potentially creating problems for the person gifting themselves, that maybe they're not going to have assets to draw upon in the future if they live longer than expected. There's a growing use of trusts and offshore bonds. Obviously, that could be an effective planning strategy, but obviously those do come with complications and tax issues themselves if they're not managed correctly. And of course, that adds cost to clients. Anytime a complicated structure is put in place, generally it's a decision that gets made once and you're stuck with it, and then you've got to manage it throughout its existence. So I think effective, but needs managing, and probably only right for much larger asset levels. And of course, then there's the classic, which is life insurance policies to pay out to cover any potential IHT liabilities. But that can be very costly, of course, depending on when they're put in place.
Great, thanks, James. I think for the purpose of today, one of the things we're trying to talk around is where can there be another part of the toolkit, and I'm sure there are many other things that their advisors are talking around that they're discussing with their clients of how they're responding to the changes. But one of the kind of lesser talked about and sort of late has been utilising Lombard lending as part of the toolkit that sits alongside those, either in isolation or in combination with a variety of those different strategies. So we'll talk about kind of the combination of those strategies later on in this. But kind of just taking a step back around what is Lombard lending first, to kind of give everyone up to that same level. So what is Lombard lending? It's a very simple concept at its core. It is borrowing secured against your investment portfolio. We analogize it very simply to like a mortgage. Everyone understands in the concept of a mortgage, you've got an asset. That asset happens to be a house, and you have an LTV. We all understand LTVs in the concept of mortgages. The main difference, obviously, within this is that that value changes on an ongoing basis, and lenders care a lot about what happens to the ongoing value of their security rather than what happens day one. The other big difference kind of relative to a mortgage where people find it to understand Lombard lender's concept is it is typically an overdraft. It is not a once and kind of here is for a specific purpose, go buy something and have a fixed amount. It is an overdraft against the portfolio, which can be used for a wide range of flexible purposes. The limits on what a Lombard lending loan can be utilised for, or a Lombard facility can be utilised for, is very, very limited. So that flexibility to draw and not only draw and repay as they see fit, but it ends up being perpetual in nature and allows people to draw down as and when they need it and utilise it for lots of different things, which, as we'll come on to, makes a lot of that flexibility to have it as part of the planning toolkit, as we'll show in some of the examples. But to bring that to life of kind of having that Lombard loan secured against the investment portfolio and that changing value, what that means in concept, or taking that concept to reality is what that means in practice, is it's really important to understand the mechanics of how market movements and that change of the value of the collateral, of that value of the asset Lombard loan, it impacts the kind of key features of it. So within Lombard lending, the big kind of LTV concept is there's actually two LTVs to care about. There is an advance rate, the amount that you're willing to lend or a lender is willing to give at the kind of the outset of a facility, and to the amount before which they have to provide additional collateral, because they say that the portfolio has fallen substantially, there is no longer enough security in place to protect this facility for us to get comfortable enough to be able to lend at this sufficient rates and these flexible amounts. So because of that second level, it's really important that people understand the impact on kind of portfolio fluctuations. And those two rates are designed to be set such that clients aren't ever at risk of these margin calls and aren't at risk of hitting that level. But it's an important concept to understand because In this example we've got here, a client has a £500,000 portfolio. They've got a facility of 50% advance rate, so £250,000 facility. They've borrowed £250,000 secured against the portfolio. The maintain LTV, the second LTV where they're providing further collateral, that portfolio has fallen to £333,000. So it's kind of a kind of therefore diverse, and this is a diversified portfolio here. We're talking kind of 40–50% falls in equity markets to reach this level. That has now reached a 75% LTV. So that 250,000 is 75% of the £330,000. And in that scenario, the client gets what's known as a margin call and has to take various actions. It could be either they provide additional collateral, or it could be that they have to sell some of their assets and repay some of the facility, or it could be that they have to rotate into lower risk assets to drive up that LTV. Because, as you see, as the nature of those types of LTVs are driven by what's in the portfolio. So a high risk portfolio with concentrated positions will attract a much lower LTV than what a multi-asset class diversified portfolio will. And those kind of that portfolio, depending upon the liquidity, the volatility, the currency, the correlation, that drives how much a lender is willing to set these LTV levels at. And then ideally, and Firenze as a lender and most good responsible lenders will set these incredibly conservatively, because no one wants to be issued a margin call. It's really important to be a conservative lender and drive good client outcomes by being a conservative, sensible lender. The second way in which you protect against these is making sure there's really good communication. So as you see on the left-hand side, this is key terminology to talk about is kind of early warnings. A good lender should be sending early warning notices long before it ever gets to a margin call, and allowing clients time to remediate them before it ever gets to kind of selling down and selling assets. So these are kind of some of the different terms to be aware of within Lombard lending. But I think that important concept of understanding it is not just a set the valuation once, it is a portfolio evolving over time, and that value continues to be monitored daily. And in the Firenze P1 relationship, we're taking that data feed directly from P1's platform into our risk engine to continue underwriting and analysing those portfolios. And it's important for people to understand that though they're set conservatively, this is the big risk kind of downside within Lombard lending to be aware of. While protected against, but important to be aware of. I think when it comes to understanding Lombard lending, the other key thing that I find it helpful for people to understand is eligibility. We look at eligibility through three lenses: borrowers, wrappers, and assets. So through P1, you have access to actually one of the broadest range of borrowers, wrappers, and assets actually in the market now. So borrowers can be individual borrowers, joint borrowers, and that joint borrowers in the topic of today as well as also can be not just husband and wife, wife, but they can be parents borrowing against providing facilities or joint facilities with their children. So you can have joint facilities in there. Family investment companies are able to borrow within the wrapper, within the corporate itself. Trusts are able to borrow, both onshore and offshore. The main kind of borrower to be aware of that can't borrow is actually trading corporates, less relevant today, but worth being aware of. I think the second lens of looking at this from wrappers is clients are able to borrow against their GIAs and their ISAs, as well as offshore bonds. And you can't borrow secured against a pension, but that's the main kind of one to be aware of from a wrapper perspective. When it comes to assets, there's lots of things on here to effectively say if it's liquid, you can generally borrow against it. If it's illiquid, you can't. But if it's depending upon the level of liquidity, level of volatility, which will determine how much you can borrow. The main kind of scenario where we see where people aren't eligible for Lombard loan, that increasingly gets asked about for liquid assets, is securities issued by companies that the borrower is actually a director of. So company shares in their own company, they're a publicly listed director, that's typically not eligible for Lombard lending. But that aside, generally for liquid assets, it's eligible. So I think it's helpful always to look at that through borrowers, wrappers, and an asset level.
And just generally, David, on the assets that you can't borrow against, obviously you've got commodities in there. You've obviously excluding gold. You've got gold in what is eligible. Is there any restriction around the investing either through like an investment trust or say an ETN, or are you talking about?
That's physical being eligible for ETNs and ETFs is absolutely fine. An investment trust is fine. the amount of BlackRock gold and gem law type stuff that seems to be floating around is able to is eligible as assets. It's physical commodities that generate typically with zero LTV.
Great.
Anything else you want to raise on here, James, around eligibility?
No, I don't think so. No, I think that's covered everything. I mean, I think what people can probably see is how flexible it is. There's a lot of opportunity to be able to use this sort of facility in a lot of different ways.
Thanks. And I think that leads now into kind of like where generally, and talking Lombard lending generally before we get specifically into the IHT side, is kind of where people, where borrowers and clients look at the benefits and risks of Lombard lending. And generally, as we've touched on and alluded to throughout all this, is that flexibility is perhaps one of the best kind of tools of Lombard lending as a solution. But ultimately, it's that ability to access liquidity without disrupting long-term plans, disrupting wealth strategies, and without triggering capital gains tax. Ultimately, that's the main thing is a client has a portfolio, they have their asset base, they have a liquidity need, they're able to meet that liquidity need in an incredibly efficient and flexible way without disrupting their investment plan. Fundamentally, that is core. That's why I find Lombard lending at its best in kind of meeting short-term liquidity needs. And that encourages clients to stay invested in the first place because they know they can meet their liquidity needs elsewhere. And I think most people start on that journey of Lombard lending thinking about it from a liquidity source, and they have a very short-term liquidity need. The amount of borrowers that we see for borrowing for downsizing property and don't want to be in a chain. They want to borrow the end of the tax year to make sure they top up their flexi ISA status because they took money out to borrow a kitchen. They get their tax bill in January but not a dividend in April. We see people start from unexpected liquidity needs, but then because of that versatility and that flexibility, we see people then start to use it for strategic long-term planning. And we'll come on to IHT in a second, but I think more generally, when we talk about Lombard lending, it's important people think about it actually, how do I leverage both sides of my personal balance sheet to achieve strategic wealth objectives? We increasingly see the client that has £800,000 and thought they'd feel very wealthy and want to be able to pass on wealth to their children and help them with their property, get onto the property ladder and give them 100 grand each for flying Clapham. But they no longer feel able to go do that because they want to make sure they've got enough money for their own retirement. And with using both sides of their balance sheet to achieve their wealth objectives, they can achieve both of those things by using leverage conservatively and sensibly and think about it in a broader context. And those wealth objectives might not just be passed on to children, it could be actually building and growing their wealth. Increasingly, we see people doing it from a kind of wanting to leverage for long-term asset growth to go build that wealth in the first place. But also those tax advantage sides of it, of the common phrase, and this is something that's been utilized in the US for a long time, the common phrase of the kind of buy, borrow, die strategy, and which we'll touch on to from an IHT perspective, of that people utilize it because they're not triggering their capital gains tax, and then let those capital gains pass away as they die. And so lots of incredible benefits that come with it, and ultimately it drives down to, we've not necessarily talked on pricing and terms here, but ultimately Lombard lending is typically 1 to 3 over base. It is an incredibly cheap form of financing as well, and can be, because you're securing against liquid assets, clients can get set up in apply in 15 minutes, cash in days is the typical type of timeline you're talking around. That flexibility and efficiency combines with a really powerful solution. That incredible, powerful solution, though, doesn't come without some risks. Clearly, there are trade-offs to factor in when you do that. The main one to be aware of is what we've already touched on, is that market risk. That is the main thing to be aware of in Lombard lending. That's why it's really important that it's done sensibly and conservatively. We've seen the US banks push really aggressive LTVs over the years. We see people go through cycles where clients are taking 80, 90% LTVs. That's not conducive to driving good client outcomes, because that market risk is a real thing. And when it does happen, it happens at the worst possible time, where the client doesn't have the liquidity, and the market and the asset values are falling. So it's the worst possible time when market risk happens. So it's really, really important that people understand that, but also use Lombard lending conservatively. The other two kind of key risks to be aware of is kind of interest rate risk, because it is a variable rate product, Lombard lending. It moves with base rate. If rates go down, they get passed on to clients immediately that day. But similarly, if clients are going up, so particularly when clients are using it for long-term planning strategies, it's important to factor in kind of rates across a cycle. And the third is kind of tax wrapper risk. So you can lend against ISAs and and offshore bonds as we talked around. But if a client, and then we're talking extreme scenarios hard, but if a client ever has to go be enforced through the courts, that could invalidate the status of their ISA. Should never ever get to that, but want to be aware of. And so in an offshore bond, if there's ever an enforcement action, it's kind of the lender, Firenze or any other lender, is not considering top slicing relief. They're not considering the different complexities and nuance of segmentation. They're just enforced to get their cash back. So it's important that these things are considered. Hopefully those risks are mitigated by being sensible lending with kind of good client communications and good client understanding. But it's important that they understand that those great benefits of the flexibility, the versatility, the liquidity, and the kind of the tax advantages do come with some considerations.
Yeah, I mean, I think just one additional but quite obvious thing with any loan is, of course, that there is a need to service those interest payments every month. So from a planning perspective, obviously, it adds to that ongoing sort of cost burden of the client. So just factoring that into planning, that additional monthly expense, obviously the loan's got to be serviced, so the risk needs to be considered.
That leads neatly into kind of giving a couple of kind of basic examples to start of kind of how Lombard lending is used from an IHT concept and kind of perspective. And hopefully through some of the things we've talked around, people are starting to get ideas already of where they can see that in an IHT concept, an IHT kind of context. But here is an example. So we're going to 2 examples, one very simple to start and one slightly more with a few more parameters into it. But in this scenario, client's got a £600,000 portfolio. We're assuming allowances utilised elsewhere, and we're assuming the kind of portfolio returns are just paid through to kind of lifestyle and income. So very simple and start. But it just shows that value of the debt, in particular, if the debt reduces the value of an estate and takes it outside of its estate for IHT purposes. So in this scenario, the client has borrowed a gift. That gift is still a pet, so the client has to survive the 7 years for it to not be included, the gift itself to not be included within the estate, but the debt staying with the parent in this example, and assuming gifts into children, that debt stays within the estate and reduces the net asset value of the estate. So in scenario 1, the client just holds the £600,000, they live off the returns from the portfolio, it stays at £600,000 7 years later, so very simplified scenario to start with. The client pays 40% IHT on that portfolio. They pay £240,000 of gifts there in IHT. The second scenario, however, that client borrows £300,000 against the portfolio at the outset, and they gift that £300,000 to their children. The portfolio returns services that cost of the debt, as James rightly alluded to, is you've got to service that debt with it. But in that scenario, remember, you're borrowing £300,000 here, but you're making returns on the full £600,000, and the cost of borrowing is largely kind of across a cycle, largely similar to the rates or slightly lower than the rate of return expected over a portfolio. So after 7 years, that debt's continuing to be serviced from the portfolio returns, but that debt has lowered the value, the net asset value of the estate. Therefore, there's 120k less of IHT to be paid in that example. Making a slightly more complex scenario here, we have a scenario where the client here has got £1 million portfolio to start with and is looking to gift £500,000. So £1 million portfolio to start, and the client in the first scenario is considering selling assets to gift to their children. To generate enough assets to be able to sell £500,000, they've had to, and in this scenario, there's a £500,000 gain within the portfolio here as well. There's not necessarily plenty of assumptions, but the client is having to sell more because they've got to pay the capital gains tax to be able to go fund that gift to the children as well, assuming they don't want to use holdover relief. But the kind of there's £53,000 of capital gains tax that if they held those gains through to death, those gains disappear upon death. Here they're triggering CGT to be able to fund that gift. Over this 20-year horizon, that residual £447,000 grows to £1.73 million. The client passes on just over £1 million to the family. And topped up with the £500,000 they originally gifted was £1.54 million. In scenario 2, they've borrowed £500,000 to facilitate that gift instead. Clearly, that gift has not attracted CGT, so they've saved themselves the £53,000 of capital gains tax, but also that larger portfolio value is able to compound even after factoring in the cost of the debt, is able to compound to greater value over the long term. So it's grow up to £2.2 million. So even after paying the IHT exposure within that larger amount, that is growing an extra £260,000 relative to a scenario where they've sold assets to gift, triggered capital gains tax, and not been able to compound as much returns. So the differences that can be made on modest sums to be able to grow the wealth over a long term and pass on further amounts to the next generation is an incredible amount of extra wealth that can be created. So there's lots of different ways that this can go through different numbers to be sensitized on and try from, but just using this as an example, clearly in this scenario, there's still 900k of IHT exposure that people would want to manage and mitigate and look for other solutions. So it's important to look at how planning strategies can be combined as well. I think it's not just important to look at the kind of the headlines of lowering the value of the estate and the borrower to gift, which is an increasingly powerful strategy, but we're increasingly seeing Lombard lending combined with other planning solutions to form part of a group of tools that actually help the clients in the broader context. So as James rightly said earlier, offshore bonds is a growing area we see as well. But it is one that rightfully comes with its own complexities and nuances and not right for all clients. But there are clients that want to utilize it as part of their planning strategy, but are increasingly nervous about the 5% withdrawal limits. So we're seeing a lot of clients set up Lombard facilities secured against their offshore bonds to help manage and ensure that they've got liquidity, they've got a backstop of liquidity should they need it secured against that portfolio, and then look at the offshore bond and managing their planning strategies across that. Similarly, trusts is increasingly utilized and sometimes both together, but trusts even in isolation. That ability for trustees to be able to borrow and take out a Lombard loan against a portfolio that's been utilized can be used in a couple of different ways. One, again, looking at managing the net asset value of the trust allows it to kind of manage around nil rate band levels and planning for 10-year tax charges, but it also can help flex and manage the kind of timing of distributions to beneficiaries and be part of the overall planning strategy, looking at the kind of portfolio wrapped within the trust. As James said, life insurance is kind of always been part of the toolkit, but I think it's increasingly kind of one of the fewer strategies that left that actually is effective and achieve what's been done. But they're kind of combining that with part of the Lombard lending solution is something we're starting to see a lot more, where people are kind of factoring in Lombard lending as part of the growth strategy and that growing of the wealth plan. And they're kind of starting to factor into how that how the kind of premiums could be met from that facility as well to factor in a larger IHT exposure that may come and combining the two together. Or similarly, we're seeing people that have their kind of core wealth strategy in place, but then using the pension assets that they're drawing down to fund the kind of the contributions towards their life cover and modeling in a variety of different scenarios together. And similarly playing around with tax-free cash limits. So there's lots of different kind of combinations of planning strategies we're seeing take place, where Lombard lending is either a core component or is a part of enablement of an broader strategy. And if anything you want to add there, James, at all?
No, I don't think so. I think the underlying theme really is that additional flexibility as a tool to create liquidity when needed and to manage some scenarios that can occur by using the vehicles that are currently on screen. It's the flexibility for clients, the optionality it gives them, I think is massively powerful. And it's something that obviously most people haven't been able to access before. I think as people start to look more into the sort of IHT planning that needs to start to come into play now, Lombard lending does start becoming an obvious part of the total planning sort of puzzle that you can put together.
And I think it's important and do rightfully that James, is something that is more broadly available. And I think that is an important part to talk about around the work that both people and friends have been at the forefront of together, is that Lombard lending was historically something you had to go to a private bank for. It was something that clients had £1 million, they had £3 million minimum assets for portfolios, and they had to move their assets to a private bank to enable and facilitate. That is no longer the case. Through P1, the minimum facility size is 65k. It's available from portfolios of 130k upwards. and you leave your assets on the P1 platform, manage it exactly the way you want, manage it and keep it intact in the way it needs to go to, and do not, regardless of size, do not need to move it to a private bank and have a competing private banker go after the assets and the client. But I think beyond just that accessibility and opening it up, I think the integration that takes care between P1 and Firenze is that it's kind of very seamlessly integrated into the platform, the facility setup, management, and reporting back to client is all seamlessly handled through the P1 platform. So it's the guys at P1 have done a great job to make sure that Lombard lending is integrated seamlessly into the offering.
And that's, I think, the key. One of the key risk mitigations is that visibility over how the loan is as a percentage of the portfolio value. The fact that that can be monitored in real time by Firenze, but also visible to the end client. So they're aware if they ever start to get anywhere near any sort of margin call territory, it's not a surprise, right? It's right there. It's transparent. It's transparent. The communication can be there well in advance of any issue ever occurring.
Great, thanks. And I think that is the last of our slides, and open up for any questions.
If you do have any questions, there will be a question box in the top right hand side of your screen. It's got a little question mark in the chat box sort of icon. If you click that and if you type any of your questions, we'll get back to them. We have had a couple come in, so I will wait for some responses and then I'll read them out.
Cool. Can we see the questions? Or are you gonna fire the questions at us and take them from there?
I'll fire them at you. So the first one is a simple one. It is, what is the underwriting age limit?
So age limit. So there isn't a hard and fast upper age limit. Any clients above, I think it's 75, get referred to like a vulnerable customers review within Firenze. But we don't have an upper age limit per se. What we won't allow though is any borrowers that have a P of A in place at the point of starting the facility. We wouldn't make someone terminate just because they need a power of attorney during the life cycle of facility, but they couldn't start a facility in the first place with power of attorney in place.
The next question is from Duncan. I understand that a typical Lombard loan rate would be set at around base plus 1.9% for a value of over £1 million. Currently, that implies a rate of 5.7% plus the arrangement fee, which then becomes an annual facility fee. What are you seeing people use the loan to accomplish that reliably surpasses these costs?
I have to say that, but I think there's two ways from like that. So there's like one, that not everyone is utilizing it for an investment leverage perspective. Some of them are, and those that do leverage will be investing and thinking over a cycle that those investment returns will be beaten through their general investment portfolios, and that rate will flex over time. Some of them are more aggressive and are investing in property and private equity and think that they're going to kind of more than accelerate those types of returns, and some that look at it from a pure investment side. I think those that are less going always are going to make is my cost going to be 5.7 versus portfolio of 5.8. They are looking at it more from factoring in that broader access to liquidity, that flexibility. They're considering the tax calculations within the overall limit, that it's not as simple as, is my portfolio doing 10 bips or 20 bips more or less than the cost of debt on any given day.
We have another one here from Kurt. Is this available within existing plans and investment bonds such as RL360 and Countrywide?
It's not currently available on onshore bonds, but for the offshore, it's just more a case of we haven't seen the demand to be able to go set up the legals in place with the onshore bond providers yet, but it's something we're happy to do if you want to get in touch with the team and ask about specific plans or specific policies. More than happy to go look at that. The framework's all in there available to go do it, but currently in the offshore bond space, we work with Utmost, Canada Life, Prudential and Standard Life.
Two more questions. First one is from Doug. What are the costs, rates and charges?
Yeah, so there is an arrangement fee to set up the facility, which I think ranges between 0.5% or kind of 0.1% to get set up the facility and to have access to that liquidity. And then there is an ongoing interest rate, which is only charged on drawn balances. So that those, if a client's not utilizing it, they don't pay. If a client is fully utilized, they pay an awful lot. That varies depending upon the size. So if a client's only borrowing kind of 75 grand against 150k portfolio, that's typically kind of 3.25 over base. If significantly cheaper than kind of your bridging finance or kind of considering those costs of CGT. If a client's starting to borrow £3-5 million plus, that's have a conversation with a team, and we've seen as low as kind of 125 over base.
Final question from Oliver. Are you suggesting using the loan to cover life insurance monthly premiums?
It's not that we're necessarily suggesting that, sense that we have seen people that when they're looking at their overall wealth strategy and combining life insurance and Lombard lending within it, there are people that we have seen drawing into their facility to meet those payments whilst allowing their portfolio returns to compound and getting that their life cover against a broader projected value or a bigger projected value in the future. So we've not kind of seen someone then again, hey, I can't afford my life premiums, I'm going to borrow to go do that, and people, the portfolio size generally mechanics isn't as vanilla as that, but when it's combined as a broader part of strategy, we certainly see people factoring in the cash flow of their premiums into the kind of liquidity from their facility.
Excellent. That was all the questions. If there are any more questions, please do type them now. Otherwise, we will finish there. Give a couple of minutes for any final questions.
I'm just glad David covered most of the questions, so that's perfect.
Sorry, James. Any of those you wanted to elaborate on?
Myself, no, I don't think so. I think you've really covered anything. I mean, I think the main thing to say is obviously there's always nuanced client circumstances. So, there's no right answer for a sort of a set example scenario. Of course, there's all the softer stuff that comes into, how the client looks at life and what their objectives are. So this is just supposed to be a tool that's available that generally hasn't been available before, that is available to consider as part of your core IHT planning strategies for clients. But there's no right answer ever. It always comes down to the nuances of the client. So it's a case-by-case basis assessment as opposed to something that you can say this absolutely works in this scenario at all times. Of course, there's much wider factors to bring in if you're talking to the clients about using this sort of facility.
Okay.
Any more questions there, James?
There was one final one from Kurt again. So just around the assumptions that we had in place, which assumed a CAGR of 7% alongside an interest rate of 6.2%. And he states that they're relatively close and the difference in outcomes is quite modest. Have we modeled these using lower investment growth assumptions? Because if the CAGR were lower, it would potentially become more favorable to retain the assets versus lending. Any thoughts on that point there?
Yeah, I think we'll also over the coming weeks actually be releasing some tools that people can play with the assumptions themselves and see the difference. I think when you factor in the tax calculations, you largely need your kind of cost of debt to be more kind of, as long as it's within 1%, no more than 1% more expensive than your expected returns over a long run cycle, you start kind of benefiting. Clearly, the compounding effect, without even considering the tax side, naturally you have to have the returns higher than the cost of debt to go do that. But also bear in mind that you're only paying the debt cost on the bit that is borrowed, whereas you're making returns on the full sum. So that kind of the netting off, actually, the equations work quite differently. But we'll be giving tools so people can play around with their own kind of equations to go do that. But we've played around with a variety of different scenarios, and that was a general sensible scenario that we're through. But if you even put the numbers as basically exactly the same, you're going to come out with quite similar outcomes.
Brilliant. Thank you very much, both. That's all the questions. If there are any further questions you'd like to follow up, then please do get in touch. Otherwise, thanks very much for your time, everyone, and we'll see you soon for another webinar, hopefully.
Okay.
Perfect.
Thanks, guys. Take care.
Cheers.